documents.
And Jack, what I refer to is I'm trying to find it right now.
But I just say, we also talk about the investment returns too, but we do, the ARC is part of the issue. I didn't want to say it's all on one side or the other.
We have our 2-page sustaining retirement security for future generations.
Right.
We have a 1-paragraph section that says, economic downturn drives funding shortfall. The primary cause of the $64 billion funding gap is the weak financial market since 2000. Annual investment returns from 2000 through 2012 averaged 4%. The magnitude of the shortfall has increased through the decade because the amount contributed to the DP program has been a decreasing percentage of the amount needed to maintain full funding. So we do mention that, but we're taking a very sort of tailor-made period of time, 2000 to the present, to say that the problem was investment returns, when in fact what we really should be doing is we shouldn't be choosing a period of time that's only a decline in the market when we know that essentially the market varies. And that's all I'm saying.
I just want to make sure that the ARC is absolutely part of every conversation for us, and I'm no way to think otherwise. But Mark, I want you to talk about the time periods or however you want to respond on your part.
Apparently, Nick and I both have an answer. I'm going to let Nick go first.
Okay.
I thumb wrestled him below the podium here. Yeah, I'd say, first of all, we used 2000. This was sort of in response to SER 105. I just kind of thought this was kind of interesting supplement issue where we talked about what had happened since 2000. And I think that's probably a lot of the questions the systems is getting. They probably weren't getting asked, well, you were 80% funded, back in 1990, and now you're 67% funded. They're asking, why were you over 100% funded, and now you're down to 67% funded. So that was kind of the genesis of why we kind of did the specific analysis. And as far as, going from your 84%, which I really like, because my daughter, she's a freshman in high school, and she knows about control variables and those things, and the way you've kind of pulled the investment return assumption out of that. I mean, so that's effectively what you could kind of do here is if you took it back to your 20-year period, is you could kind of pull out the blue investment experience and be kind of the other items which really would drive that change from 84 to 67 you talk about. And the last thing I'd say, I mean, I actually had considered this when we were putting together the slide, which would be to show a parallel line to this red funded ratio to show, what the funded ratio would have been if we'd have funded according to the actuarial, the actual recommendation, which I think since about 2002 or 2003, we've been putting up front that, we should increase the funding ratio to satisfy the 30-year contribution. So we could have a parallel line here that would be slightly higher than the 67%. It would start close, but as the lack of underfunding has occurred over 10 years, it would somewhat diverge. It obviously would not put us back at 100% right away. It would only be slightly higher than 60%, but that would be sort of an interesting piece.
That'd be helpful, actually. I'd like to see that. Yeah.
Okay.
I'd like to add a couple of comments. Around the country, with some of the plans that are very, very poorly funded, I think it's fair to say the primary cause has been underfunding contributions. And it's been, sometimes it's 20 and 30 years of just very poor funding. And even through the bull markets, it didn't help very much because the funding was so poor. So, I mean, you're absolutely right. And even with CalSTRS, if you go back when we were pay-as-you-go, had we been, and I'm going to say this, more closely funded on an actuarial basis, we would have withstood even this downturn and been very well funded. I mean, if you go back to 1970, before the Richard Barnes Act, which started some pre-funding, had we been much better funded, closer to being fully funded, we would have been a lot better off even today, even with the downturn. So, and we've got graphs and we can look at those numbers. So yeah, it is, the funding does make a difference because that allows you to build up assets in good times and withstand some of these very, very poor downturns. So just absolutely right in the observation.
Well, I still don't want to be left out. So I think there are actually 3 correct ways that I could look at this. One way is what this chart presents based on the actual decision that was made by the legislature. Well, why, there were assets at that time, and it was anticipated that the plan would make 8% investment returns. Based on those assets, the decision was made to improve benefits, and there was some reduction in the state contribution at that time. And so this answers the question, why are we where we are based on that point? And that to a large extent has to do with the fact that investment returns since that point are not anywhere close to what we anticipated them being. That's one way of looking at it. Another way of looking at it is based on the benefits. If we looked at the 1990 benefit structure, what we see in the report is that if the changes had not been made, we'd be about 88.4% funded instead of 67% funded. Now, if we go back and look at that 84% funded ratio, which was calculated at 8%, and adjust it for the current 7.5% assumption, it would probably be somewhere around 78% funded. So now we're going from 78% funded up to 88.4 over a 19-year period. Well, I would generally expect more than that. My understanding is that back then we were under an even looser amortization policy of 40 years from 1990, which means we'd be amortizing over about 37 years from 1993. Well, 19 is roughly half of 37 years. Going from 78 to 88.4 is not all that far off of where I would anticipate being. Now, that's a long way of getting to my second way of looking at it, which is if when the legislature made the decision, they thought we were going to be 88.4% funded based on the 1990 benefit structure, the decision probably would have been don't increase benefits. So that is a benefit issue. You can look at it from the fact that investments since then have not been as high as we would have anticipated. You can look at it that if we'd really anticipated back in 1993 only earning 7.5%, benefits, okay, so investments benefits would not most likely have been increased, or you can look at it from a contribution standpoint and say, based on the fact that those contributions were increased, and there was no way anyone knew at the time that we would average 7.5% over the last 20 years, but if we'd known that, based on the fact that those benefits were increased, there should have been additional contributions put in if we'd had a crystal ball. And no one has a crystal ball to know what the future investment returns would be. All three of those are actually correct. I think what the system gets back to is looking at what's the best way to communicate the best way to communicate the message so that people really understand where the system is today and what its needs are. And it's interesting because I think we all agree that the bottom line is that the system needs more contributions. So.
Anna?
Just following up, my initial reaction to this chart was similar. When I think of historical perspective, I think about far longer than a decade in terms of what I'd be interested in seeing. And I think it'd be helpful to look at going back further in time, particularly given the extent to which the level of fluctuation that we've seen is greater than what we had seen in prior decades. But early 90s, we saw substantial declines as well as in the early 80s.
All right.
I have one more.
Go ahead.
Can we look at page 19? Mark said it's one of his favorite. It's one of my favorite too. And it's the one that talks about what happens if the investment returns are less or more than we expect. And I think to me, it makes the argument that the cost of a downside underperformance is much greater than the benefit of an upside overperformance, because we have a 25% chance of getting 850, which would reduce our necessary additional revenues from, trying to read this, basically from 15% to 7.5% of payroll. So it would save us 15 minus 7.5 or 7.5% of payroll. But we also have a 25% chance of getting to 510, equal chance to getting to 510, and that would increase the amount of contribution from payroll from 15% to looks like 36, 37%. In other words, 22% or 3 times as much. So am I right in sort of saying that sort of in just dollar amounts that the impact on what we would have to, the additional contributions that would have to be made if we got to the 510 would be 3 times as much as what we would save if we got 850?
Actually, it's a little deceptive because that would be true if 7.5% was the 50th percentile. But as Mark talked about, these are the recent capital market assumptions for 10 years, which actually are quite a bit lower. The 50th percentile is actually less. So the upside of investing over that 50th percentile should be fairly close to the downside of hitting less than that 50th percentile. Do you follow what I'm saying?
So I mean, that would have to be, so what, the 50th percentile is what, like 7%?
It was actually about 6.8% based on the recent capital market assumptions for a 10-year period. We were trying to, as Mark said, this was just for illustrative purposes. If we were setting an assumption, we wouldn't set it necessarily based on 10-year returns, but it was just to give an idea of variance.
On the 10-year PCA,
Yeah.
you're saying that was
The
6.8.
10-year,
The new ones.
the 10-year history or the?
No,
For the next 10 years, looking out 10 years from 2013 to 2023, looking over that, projecting, guessing over, and I don't mean to say that disparagingly at all, but best estimate over the next 10 years, their assumptions.
Okay, help me there, because I thought the whole point was that this board has adopted investment assumptions that say we think we're going to get 7.5%. And
Right.
what you're saying is, yes, but this board has said we're going to get 7.5%, but at the same time, this board has adopted capital market assumptions, which when PCA crunches them into their models, PCA says, well, no, you're only going to get 6.8%?
Yeah. The capital market assumptions can have quite a bit of variance from one year to the next, and if we were resetting the actuarial assumptions based on each year's capital market assumptions, we would see a lot of variation in the required calculations each year. Interestingly enough, on the corporate side, private plans are forced to change their assumptions quite radically each year, and what we see is that they're finding it very hard. Well, what we saw was that they were finding it extremely hard to bear with the volatility of changing their assumptions every year. And I don't know, you're aware, there's some legislation that was recently passed called MAP 21, which took a great deal of that volatility out of the setting of those assumptions on the private side. So that's a long way of saying that we don't think it prudent to change the assumptions every year to match the 50th percentile of that year's capital market assumptions. When we spent a lot of time talking about setting the 7.5% assumption, and we're not recommending getting into that conversation today for the purpose of this. That's why we showed the 7.5%. That is what the board has adopted. But we wanted to give you an idea based on some measure, and we thought that PCA's hot off the press 2013 assumptions was a good measure to use, 10-year assumptions, for an illustration.
Okay,
That's where these came from.
So then what you're saying is that right now, the 50th percentile expectation of 10-year returns would require much more than a 15% percentage point increase in contributions.
that's correct.
Yes.
So when we say all we need is 15% to address the unfunded liability over a 30-year amortization period, that's actually low based on the capital market, PCA's 10-year capital market assumptions.
Yeah, and I just add, I mean, that's why we talked about having a buffer. That's why we'd like to have, a little bit of margin, a little bit higher contribution rate to absorb some of that thing. But I will turn over to Chris. I think he may have something to say about investments.
Well, no, just I would add, so they're taking PCA's assumptions and applying it to our asset allocation as it currently stands. And so your comments are correct. You take PCA's assumptions now, and as we've discussed, you'll see those tomorrow, much lower assumptions on fixed income. So if you have 20% basically at almost zero after inflation, then the numbers don't work well. That's why we'll go through the asset allocation study, and you'll look at different asset mixes coming up in June. So I think if you remember, this was actually at the offsite, we had a discussion about the chicken and the egg. Is the actuary set the 7.5, or the investment committee set the 7.5? The investment committee sets the 7.5, but that's based on what you think is the right asset allocation mix and what you think would be the right return. The capital markets assumptions will be the first step. So you're seeing it a bit out of order. These guys are here now saying, today, looking back at our asset allocation and our goal of 7.5. Tomorrow, you'll start talking about new assumptions, and then in June, you'll set an asset mix that will tell you, okay, I'm willing to take this much risk, so that's about what I would expect to return.
Paul, you good?
Yeah.
Rich?
So, can I take a run at this? You're gonna have to bear with me a little bit. When you talk about a 6.8, what does that mean? How do you get that figure? Where does that come from? Is that a collection of all the guesses about what things are gonna be over the next 10 years? And you find the midpoint? How do you do that?
Do you guys want me to answer that?
I mean, I would just answer that basically in a nutshell, but I'll turn it over to Chris. He might have a more erudite answer.
No, yeah, it's like, why am I jumping in front of the actuaries?
I'd love to hear
Take
Chris. I'd love to hear Chris's answer.
Oh, ow.
I meant that respectfully.
Oh, thank you. The PCA assumptions are built on their capital markets methodology, which we'll go through tomorrow. Starts with an inflation rate, then goes to a risk-free bond rate, then assumes an equity risk premium. Long-winded answer to where we stand today. PCA is projecting out over 10 years. They took our existing asset allocation, ran it using those assumptions, and the new volatility numbers that we'll look at tomorrow. And those aren't yet approved and adopted, but that's the best they had.
So for each of the asset categories, I want to make sure I follow this along. They have a set of assumptions that they use, and they make a guess of what's going to happen over the next 10 years. Is that right?
And which is based on history. Yeah.
Okay. Ooh. Okay. Yes, I don't doubt their experience in doing this. Where does it fit, for example, with the 100 other people doing the same thing?
You'll see that also tomorrow. We did a survey of the leading institutional investment consultants. So kind of like our peer group, who do they look to as their consultants? We have an entire survey of all of them to know where their capital market assumptions. When I said it's based on history, we recognize we're trying to estimate what the future will hold, and I would agree with what the actuaries did at their party gathering, is we'll be wrong. We know that. The future will be different than we expect. But it's based on the past 85 years of investment history. What's been the typical volatility and what's been the average? So can we assume that going forward?
I got to try to, in getting ready for tomorrow's conversation, it's like, how do you judge? Right, because at the end of the day, the question is, what's our investment target number, which is not the same as what they've done here. And this helps me explain why the volatility is so great, as you were describing, because that changes all the time, right? It's like we pick this point, we run a bunch of numbers, and we guess for the next 10 years, and that's what we did this week. But last week we did it again, and the numbers looked like something else, and so there's a lot of volatility, but we have to pick an investment number based on a weird assumption of sort of stability of the way things are going, because we pick it for a longer period of time, and we make a guess at where that's going to go based on those kind of reasonable assumptions. So it's hard for me to, if it were baseball, okay, I'm just trying to put this in a way I can understand it. If it were baseball and we were going to have a guess of what everybody's batting average was going to be next year based on their past performance, okay, and actually baseball's gotten fairly sophisticated with this kind of right? This kind of analysis. So you could go back and you could look at last year's set of guesses and write about what this year's set of averages would be. And you could say, okay, here's our track record on last year's guess versus this year's performance. Given the, without asking about yours in particular, because although I suppose that's an appropriate question, but without asking, can you tell, is there a history about how good we in a very large generic sense, are in guessing 10-year averages? Because I assume we can go back 10 years, right?
Yes.
And see what what the consensus thing was, and then match that up with, in fact, how performance was over the intervening period. How good are we? If you've got a scale like this, what's our margin of error? Is that the right term? I don't know if that's the right term. But what's our margin of error in
You'll see
doing
it
this?
tomorrow, it's very wide. It's,
Okay.
like in US stocks alone, I think it's 12 or 15%,
Okay, so
plus
the-
or
the
minus.
certainty we get out of any of these projections, not terribly great.
You're going to kick out of this, and Ann, I have to warn you, I guess this office or this board is addicting. Pedro sent me an email this morning questioning that, almost that exact question of how accurate were these predictions in prior years? In the 80s and 90s, they were way too low, and reality was much higher. In the decade of the 2000s, the assumptions were way too high. If you go and look back at the not the 30-year period, but you go back and you look at the 20-year period, they're fairly close. The volatility was wider, and as you remember, we spent a lot of time talking about the left-hand tail was deeper than we expected. Should be 1%, maybe it's closer to a 4% outcome. So the tails are fatter, and that's what a couple of the key takeaways. In your baseball analogy, and you know I love analogies, so I'm jumping on that one.
Yourself.
This literally, what these guys are talking about is they're already trying to take and project how that team finished at the end of the year and having to make those assumptions. Tomorrow, you're going to go back to before the draft. PCA is going to say, here's all these stats. We think they're reasonable. These guys are batting, but it's plus or minus on their batting average. These guys' error rate. When you pick that 7.5, the better way to think about it is you're going to pick how much risk you're willing to take. And what they're telling you is this plan is very sensitive to volatility and it's not healthy.
Right.
So how much, when you build that team, I guess to take the analogy further, and I apologize, but it literally is like we're a ball club and we're not making enough money. We're not the Yankees with this big contract. So we're, maybe, I don't know, the Kings, we're barely breaking even and we're probably losing money. How hard are you willing to risk on that lineup of ball players to try and win a pennant versus, have a good year? So you'll pick the level of risk you're comfortable with. That will tell you, based on these assumptions of the future, what kind of return within a range. That would cause them to go back. If you changed it and said, you know what, I'm not willing to take enough risk to get to 7.5 with those assumptions, then these guys would have to go back to work and come back to you and say, okay, that changes the numbers.
Right. So, to go back to the previous chart, right? What happened is, it seems to me, that with the little red line in it, right?
Yep.
11. Okay. Oh, there we go. So what it looks like what happened to me is we were somebody was having the same conversation in the year 2000, right? Everything was hunky-dory. Life was good. We were all making 13%. They said we were going to be doing that forever. So they increased benefits. They reduced contributions at exactly the wrong moment in time, right? And now, since we can't do anything about the benefits piece, right? And rate of return is, probably within a relatively limited range. Can we do anything about that? Okay, so we're stuck with the only piece that's left, which is if we're going to get it back up again. And one of the problems we always have, including at this moment, is that our window of what we get to look at is extremely narrow, and it's always informed by our recent past history. So our recent past history is 2009, 2010, 2008, 2009, 2010 looks miserable, right? So we're looking at it, we really look at it through that lens, whereas the folks, when they made these decisions in 2000, the horizon was very large. Now ours is very narrow, so that's,
It's a quarter after 4. We
Just a couple things. One is, with respect to Rich's comment, when the analysis was done in 2000 around the benefit changes, the assumption was not made that the 13% was going to continue forever. It was absolutely based on the assumption going forward of 8%. I mean, in retrospect, obviously, over the last 10 years, that's been wrong. But, you know, the analysis is always done based on the board's assumption at that point. The other thing is it's also important to recognize, as we've said, just so that people sort of keep this in mind, is that in terms of the contributions that we receive from the estate and the member and the employer is marginally more than sufficient to cover the ongoing cost of the benefits. It's because we haven't met the assumptions is what's caused the unfunded liability. And then this the last thing is I just, again, as Mark and Nick have said, it's important to recognize that what PCA is assuming is based on a 10-year projection, not and what the assumption that you adopted last year is based on a 30-year number. So I think we need to be careful not to extrapolate from this one estimate that's being made now for what happens in the next 10 years, is assuming that's going to be, you know, that it's appropriate to start taking a look at our 30-year assumption. I think it's best, and I think that's what they're saying is you know, we have a cycle for looking at these assumptions every 4 years. We will look at this again in 4 years. We'll look at mortality. We'll look at inflation. We'll look at everything, and we'll take a look at the investment assumption as well.
Are there any final comments? I think what we would like to do is take each one of these separately. So is there anything, Anna?
I have one more question. You mentioned a couple of times the issue of the state payroll, the fact that payroll is calculated in arrears. In thinking about the recent past, that's been to our advantage, right? Just both in terms of the base of the calculation for the supplemental as well as the base contribution, right?
Yeah.
All right.
Yes.
Is there any further questions on the defined benefit valuation? There's a resolution. I'd accept a motion to accept the valuation report. Motion to accept. Second. It's been moved and seconded to accept that report. All in favor say aye. Aye. All opposed nay. Alrighty, the motion is, any abstentions? That motion is passed, Jennifer, and we move on to the next one.
Okay, I'll go rather rapidly, but please slow me down if I go too quickly on these. So I'm going to go over the defined benefit supplemental program and the cash balance benefit program. These are two very similar programs, which vary largely in the who participates in them and the size of the programs, but they operate almost identically. The purpose in our evaluation is to determine the financial condition by comparing the fair value of assets. So we're actually looking at a market value of assets in these valuations, not an actuarial smoothed value of assets. Compare that to the actuarial obligation to get the funded status, and then make recommendations to the board considering their policy of either granting or not granting additional earnings credits or annuity credits, and what doesn't go into those credits goes into the remaining reserves. This year, the results assume no additional earnings credits, and based on the board's policies, we would recommend no additional earnings credits. Both programs have small surpluses as of June of 2012. The funded status decreased for the DBS from 103.6 to 100.6, for the cash balance benefit program from 104.7% to 100%. There is actually a small surplus there. If we carried it out further, it would be 100.02%. So there is indeed a small surplus. The decrease was due to the actual investment return being less than assumed. That was somewhat offset by the fact that actual interest credits were less than assumed. They were credited at what's called the minimum interest rate, which is the based on the 30-year Treasury. So the board's policy would say there'd be no additional earnings credits this year. So for the defined benefit supplement program, this chart really repeats what I just said. The prior year return was 1.7%. Therefore, there was a gain on the actuarial obligation of $215 million. That's because the minimum interest rate was 4.25%. That was less than the assumption of a 7.5% credit. The actuarial, excuse me, that was for the $215 million gain. For the assets, the actual return was 1.7%, which was less than the 7.5%, which created a $466 million loss, for an overall loss of $251 million, which decreased the funded status. Again, based on the board's policy, there would be no additional earnings credits. Looking ahead, the minimum interest rate this year is 3.75%. If the fund was to earn the 7.5% assumption, that would improve the future funded status. However, actual investment returns will continue to have a significant impact. That was rather quick. Were there any questions before I move on to the cash balance benefit program? Oh, very good. Yes.
Been moved, seconded, all in favor say aye. Aye. All opposed, nay. Any abstentions? All right, we've approved the DBS evaluation. Thank you.
Cash balance benefit program is very similar, only smaller. Instead of $8 billion, we're looking at $158 million. Prior year return was negative 2%. In the same manner, on the actuarial obligation, this created a $3.9 million gain. On the assets, it created an $11.2 million loss, for an overall loss of $7.3 million. And therefore, it has a decrease in funded status. No additional earnings credit would be consistent with the board's policy. Looking ahead, it has a 7% assumption. The assets are invested a little bit differently. But again, if the plan earns the 7% assumption, that would improve the funding on a go-forward basis. I should also just briefly mention that with both of these programs, they're right around 100% funded. And part of what we see here is that the benefits actually adjust to the actual investment returns because of those minimum interest rates. We're crediting 4.25% on the accounts this year instead of the assumption of 7 or 7.5. And there's, these funds are able to make up lost ground due to that. It seems to be working very well.
Yeah, I'd just say I know Mark speaks at a number of national conferences, and he definitely is very high on the program set up with the flexibility of it, and it really is a success story that, consider all the bad things that we've talked about the DB program that have happened over the last decade, that these funds are still 100% funded.
Seconded to approve the report of the actual evaluation for cash balance. All in favor say aye. Aye. All opposed nay. Any abstentions? So approved.
I will pass on to Nick to talk about the SBMA.
Yeah, I'd just say the supplemental benefit maintenance account is, we don't need an approval on this one. This is, we usually do this every other year. We do a projection, and it's scheduled for the next valuation. Ed just requested we just do a real quick update just to let you know what's going on with that, what's happened over the last year. Obviously, the less than expected return has hurt the DB program. The SBMA is actually credited with the assumed investment return, so actually that it was not harmed by the return that happened. So it's actually better off slightly than last year. The second thing that affects it, and really since the assumption of interest crediting, the interest crediting equals the assumption, there's not the volatility on the investment return, it's really the inflation that drives this one. Inflation was lower, and when we did the projection, we used our setup from last year. If you remember right now, the SBMA is set up so the purchasing power can be between the 80% and the 85% level, depending on how well it is funded, and it's at the 85% level. We do a projection out to 2089, which is a statutory year. And last year we said that if that 85% limit wasn't there, we could actually go out to 87%. And this year we could actually project it out to 88%. Obviously, there would have to be legislation to change that, but it just means that 85% is a little bit more solid. But as I talked about, inflation is going to be a key driver there. As an example, we put down if inflation was 4% instead of 3%, all of a sudden you'd go from having that 85% level to not even be sufficient at the 80% funded. So, but with this, once again, is similar to the CBB and the DBS, where it has the flexibility and has done well over the last few years.
The MPPP.
So Medicare Premium Payment Program, this is the one we do on the off cycle for the SBMA. We do the MPP program, funding valuation every other year. It actually does affect the DB program valuation slightly because we have we include the obligation as part of the DB program for funding purposes because we allocate contributions to the DB program to pay for these MPP benefits. So our calculation is kind of projecting the value of the future benefits to be paid from the MPP program, which is accounted for in the DB program. So since we don't have we have a separate fund, but it's only very small. So basically on this one, changes since the 2010 valuation, we did a study I don't know if you remember this, right after the valuation, we did a study of enrollment because that's a very big impact. We don't know which members of CalSTRS will elect to enroll in the MPP program. Depends on whether they have coverage from their spouse or other employment. And what had happened was the enrollment was running much lower. Much fewer people were enrolling in Part A, Part A being the big driver. And so we made an adjustment which back at that point, so it was after the 2010 valuation, and that's reflected in this valuation. Looking at the results, we have an actual obligation of $424 million, and I'll talk about that's significantly down from the $600 million, and a big part was that change in the enrollment assumption that occurred after the 2010 valuation. We also have to do a separate GASB valuation just because of GASB's requirements, and that results in a very significant funding picture than the funding valuation. And one thing I just have to apologize a little bit, we are providing new actual assumptions to go with this valuation. We were able to get the data in December, and we were able to get our work done late in January, but we weren't able to get that obviously in the February board meeting, and obviously there's no March board meeting, so we're presenting this in the at the April board meeting, and it's obviously included in our valuation report. But going over the assumptions, one is demographic assumptions, and we base those similar to the DB program. Since the MPP program is closed to new retirees after June 30th, 2012 are not eligible. The only thing that's really driving that is mortality. No change there, same as the DB program. Economic assumptions, the 2010 valuation used 7.75%. We're now recommending a change to 7.5%, once again to be consistent with the DB program. The enrollment I already talked about. We're recommending no change since the change that was made right after the 2010 valuation. I would note that we did study that, and we did see slightly higher enrollment after age 65, but we actually expected that because we expected a little bit of a bulge when the MPP program was shut off to new entrants of people retiring immediately and taking that MPP program benefits, and I believe we did see that, so we expect that to level off going forward, so we're recommending no change in our assumption there. So the one thing where there is a change that I just want to highlight, this is the medical trend or the inflation on medical, which has been running, at some point was kind of running out of control, but has really gone down recently. So we spent a lot of time talking with our healthcare actuaries. They're kind of the experts on this. We know a little bit, but obviously we defer to them. And what you see is a very big decrease, and that's why I want to highlight it on the Part A was 5%, so expecting 5% increases every year in the Part A down to 3.5%. And I just probably the best supporting evidence I can provide you on that, outside of telling us our healthcare actuaries who are experts and deal with it every day have advised us this, is there's a 2012 MedPAC report to Congress. MedPAC is the Medicare Payment Advisory Council. They're an independent congressional agency. And they provided a report to Congress just last year, and they were projecting 1.6% increases in Part A over the next 10 years. So they're projecting even less than our 3.5, but we, as usual, we kind of like to go part way, particularly it's only a 10-year projection. But we felt it was appropriate to make a really significant reduction, and we usually wouldn't do this, but given the current environment, we felt that was appropriate to lower to 3.5%. And the Part B, I would just mention, is only about 1% of the total liability for the Medicare premium program, and that we're recommending lower to 4.5%. So as I talked about the benefits, it's only for current retirees right now. Future retirees are not eligible. Thank you, Mark. We need Vanna here. And as I talked about, recent experience has been very low increases. In fact, the Part A, since the 2011 rates, which we used in the 2010 valuation, were $450 a month. They have actually decreased in the 2-year period to $441. And similar, there's even a bigger decrease in Part B, which the Medicare premium provides the penalty for that, pays for the member's penalty for late enrollment, and that decreased from 115 to about 105. So significant decreases, and you'll see that in this next chart, which show the decrease in the actual obligation that occurred over the last 2 years. You see this about $602 million, the 2010 valuation. The $82 million, which I talked about, was a change in the enrollment assumption right after the valuation. And then the other change is the investment return assumption going to 7.5. That increased about $22 million of the obligation. And then the other two are the expectations on the on the premiums, which are both past and future. You can see the past is the premium increase less than expected. That caused a $58 million decrease. And the assumption changes, that's lowering the Part A premium from 5% to 3.5%, caused a $53 million decrease, bringing us to about $178 million decrease to a total actual obligation of $424 million for the Medicare premium payment program. Actual value of assets, we have a separate teacher's health benefit fund, but that's only funded on about a month's worth of payments. Where the assets are effectively set aside as we allocate future DB contributions to be used to fund the teacher's health benefit fund, and then we include the obligations with the DB program, and we kind of effectively set aside assets in the DB program to pay that, but since we can't use those assets, we're actually taking them from contributions. And what you see is we set the actual assets equal to actual obligation of about $424 million, and as I said, the Part B is only about 1% of that, about $4 million, so it's about $420 million to the Part A. We've got $0.4 million sitting in the THBF, so we have to allocate about $423.8 million from the DB program contributions. So that's what we saw in the DB program valuation. So that's the funding aspect. GASB, since we don't have separately allocated assets, we can only include the assets that are sitting in the Teacher's Health Benefit Fund, which is less than $500,000. So when we actually look at the funded ratio, it looks really bad, but as you know, we already have this allocation mechanism of the future DB program to cover it. So if somebody looks at our what's in the CAFR showing the funded progress, which I'll show you on this, it's going to look bad because if you look at the right-hand column, it's going to be 0.1%, because we only have in column A there about 400,000 sitting in the THBF versus 582 million in actual accrued liability, which we have to calculate at a lower interest rate because of GASB requirements. But you can feel confident that we do have a mechanism to fund these benefits. So just there's a disconnect between the GASB and the funding.
And so just to break in, that's a preview of the, 2 different sets of numbers you're going to be looking at from here on with the new GASB implementation, which is coming very rapidly, so within a year or so.
Yeah,
so,
for the pension. Hey.
For the pension plans, yeah. So.
All right, are there any questions? Nick or Mark on the Medicare premium program? I entertain a motion to also accept that report. It's been moved and seconded to accept that report. All in favor, say aye. All opposed, say nay. Any extensions? We've accepted that report. Mark, thanks.
Thank you
Very
very
much.
Thank you very much.
Thank you.
Congratulations on your reelection. I was telling Mark, it's kind of
Thank
like
you.
when we have our holiday dinners and then the family says, boy, you did such a good job. You should do it next year.
Why, thank you, Dick. I wish my cooking was that good. Well, actually, wait a minute, my cooking is that good. All right, I'd like to take a 5-minute break